On July 29, 2026, the Federal Reserve followed the consensus and kept interest rates between 3.5% and 3.75%. Typically, a decision to hold steady brings calm, but within minutes of the announcement, a wave of sell orders hit the floor. The market panicked. This chart visualizes the scale of the shock. Financial markets operate on the confidence of future stability. This specific announcement signaled that the path forward is anything but stable. The panic stemmed from a detail buried in the fine print. The vote was not unanimous. 3 members of the committee, Beth Hammack, Neil Kashkari, and Lori Logan, voted against the majority. They called for an immediate quarter-point hike. A public 9-3 split suggests a breakdown in the Fed's normally unified front. It tells the world that the central bank is locked in an ideological battle over how to handle rising prices. To understand why they are divided, let's look at how interest rates work. Hiking rates intentionally makes borrowing money more expensive. Higher costs force people to spend less. When demand drops, companies must lower prices to find buyers. That tool works well when people are spending too much. But the 2026 inflation data isn't being driven by consumer spending. It's being driven by a lack of supply. Geopolitical conflict in the Middle East has directly spiked the cost of crude oil, creating a physical disruption that the Fed cannot control. Using a high interest rate to solve a physical oil shortage is like trying to fix a leaky pipe with a hammer. It addresses the wrong part of the economic engine. The 3 dissenters argue that regardless of the cause, inflation is too high. They want to hike rates now to prevent these prices from becoming the new normal. The majority, led by Chief Kevin Warsh, believes monetary policy is powerless against blockages in the physical world. A higher interest rate won't drill a single new barrel of oil, nor will it move cargo ships through a port any faster, or reverse the impact of international tariffs. They fear that hiking rates now will crush the labor market, killing the golden goose of a healthy economy without actually lowering the price of fuel or food. The FOMC is effectively trapped. They can ignore the inflation and risk a permanent price spiral, or they can trigger a recession that might not solve the problem. That ideological split is why the Dow dropped nearly 1,000 points. The market is reacting to the realization that the Fed is divided. Investors rely on a long-term strategy from the central bank. The 9-3 vote proved that no such strategy currently exists. Instead of a clear path, Wall Street is now forced to react month to month, swinging with every new inflation report. The stock market plunged because the central bank lost its aura of absolute control. For now, the world's largest economy is flying blind. The July decision functioned as a tactical delay, buying the committee 6 weeks of breathing room until their next meeting in September. They are gambling that global tensions will ease and supply chains will fix themselves without the Fed having to intervene. If that bet fails and prices remain high, the pressure from the dissenters will likely force a painful, recession-risking rate hike in the fall. When global supply chains break, even the world's most powerful central bank loses its influence. They are left in a position of waiting, watching, and hoping for the best.